Let me start with a question. If someone earns $50,000 a year, they might pay around 20 to 25% of their income in taxes. But many billionaires sometimes pay a lower effective tax rate than that. How is that possible? Are they cheating the system? Not exactly. In most cases, they're simply using the tax rules differently. And the key reason comes down to one simple difference. The rich often earn money differently than most people. Salary versus assets. Most people earn money through a salary. You go to work, earn a paycheck, and taxes are automatically taken out. Your income is taxed before you even see the money. But wealthy individuals often earn money in another way. They earn money through assets. Assets are things like stocks, businesses, real estate, investments. And here's the important part. Assets often grow in value without being taxed immediately. For example, if someone owns stock that increases by $1 million in value, they usually don't pay taxes on that increase until they sell the stock. So if they simply hold the asset, the value can keep growing tax-deferred. Capital gains versus income tax. Another reason the rich pay less taxes is the difference between income tax and capital gains tax. Income tax is what most workers pay on their salaries. In many countries, this can be 20% to 37% or even higher. But profits from investments are often taxed as capital gains, which are usually taxed at lower rates. For example, in the United States, long-term capital gains are often taxed around 15 to 20%, depending on income level. So someone earning money from investments might pay significantly lower taxes than someone earning the same amount from a job. Borrow instead of sell. Here's a strategy many wealthy people use. Instead of selling their investments and paying taxes, they borrow against them. Let's say someone owns $50 million worth of stock. Instead of selling shares and paying capital gains tax, they can take a loan using those stocks as collateral. Banks are often willing to lend money to wealthy investors because their assets act as security. The loan gives them cash to spend, but loans are not taxable income. So they can access money without triggering a taxable event. Meanwhile, their investments may continue growing in value. Real estate tax advantages. Real estate also provides powerful tax advantages. One example is depreciation. Even though property values often rise over time, tax rules allow property owners to claim depreciation as an expense. This can reduce the taxable income from rental properties. There are also strategies like 1031 exchanges, which allow investors to sell a property and reinvest the money into another property without immediately paying capital gains taxes. This allows investors to keep compounding their wealth while delaying taxes. The power of long-term investing. Another advantage wealthy investors use is long-term holding. If assets are held for long periods, taxes can be delayed for years or even decades. During that time, the investments continue to grow through compound growth. And when assets are eventually passed to heirs, some tax systems even allow something called a step-up in basis, which can significantly reduce the capital gains taxes owed. Important reality. Now it's important to understand something. Most of these strategies are legal. They exist because governments want to encourage investment, business creation, and economic growth. But it also means the tax system often treats investment income differently from wage income. The lesson for everyone. So what does this mean for the average person? The lesson isn't that taxes are unfair. The lesson is that how you earn money matters. People who rely only on salaries are usually taxed one way. People who build assets often benefit from different tax rules. That's why many financial experts say the path to long-term wealth involves owning assets, not just earning income. Assets can include stocks, index funds, businesses, real estate. These assets have the potential to grow over time and create opportunities for more tax-efficient income. The big takeaway. The rich don't necessarily pay less taxes because they break the rules. They often pay less because they play a different financial game. Instead of focusing only on earning income, they focus on building assets. And assets grow in ways that are often taxed differently. So the real question isn't, why do the rich pay less taxes? The better question might be, how can you start building assets too?